Hello, fellow traders. 'Tis I, the Rumpled One. It is Wednesday, July the 4th, the year 2018. Let's talk trading. Free trade. A lot of traders post about something they like to call a free trade. In other words, they've entered a position and the position's gone their way. Maybe they've taken some of their money off the table, book profit, and they consider the rest of it a free trade. But it's not really. Every penny in your account is your money. And it's real simple. Either there's money in your account or there's not. If the money is in your account, it's your money. It's not the house money. It's not free money. It's your money. And every penny needs to be treated the exact same way. It's one of the fallacies that I guess you could say research came up with, that house money, free money policy. And so, as you're trading on Independence Day and for the rest of the year and the rest of your trading career, just remember that it's not free money, it's not a free trade. No, it's your money, it's your trade. And just because you may have had a successful trade last time, and let's just say you made $100 on your last trade, that's not free money. You don't, if you lose it, you just lost $100. You didn't lose $100 of somebody else's money, their house money. You lost $100 of your own money. So just, burn that into your brains. And so so words like free trade and free money and house money, uh, take those phrases and concepts out of your vocabulary. One thing that you might can replace it with is more money and risk management, because you see this ties in. This definitely ties in. It's your money. So how much of it are you willing to risk? Are you really, if you just made $100, are you willing to risk $100 on the next trade? Answer that question. Okay, as we can see here, we'll get right into it. Monthly, we've come out of the upper wick zone and we're just hovering there on the yen. Now, once again, I could flip through all these pairs, but I like to stick with one pair because it's more instructional. Now, maybe you don't like trading the dollar yen. I used to hate trading the dollar yen, just like I used to hate trading Apple Computer. But I learned what I hated about these instruments was something that I could turn around and use to my advantage because of how they trade. If you're wondering how do they trade, well, back in the day when I was trading stocks, Apple, it would march forward about 5 pennies and come back three and march forward. It was pretty much predictable. And so when you're swinging 1,000 shares at a time, I mean, that was anywhere between what, 69,000 and I don't know, $200,000, a trade, 1,000 shares, 3 cents was $30. You do that 4 or 5 times a day, you got some folding money. And so, same thing with the yen, very predictable, very methodical in how it's traded. Now, I'm not saying that to convince you to trade dollar yen. That's up to you. You can see here we've just crossed over to the downside, the cross below that weekly open. Okay, weekly open, we're down 4 pips. And you can see prices just hovering. Once again, it's the holiday, not much action going on. But in the weekly, we popped in and out of that wick zone too. Daily, you see there was a breakout to the downside here. Oh, that was probably good for what, 23 pips or so? And in fact, you can see that was a rat reversal or a continuation trade here because we had a turn right here, price turned. So now we had a continuation, which is a very nice setup to trade. You just look for these turns because you see, price, whenever it comes off the top, you're always going to have a green followed by a red, and then price will go down. When it does the bottom, you have a red followed by a green, and then it turns up. You can see here it happens. Now, in this particular case, you see if you took that turn trade and it reversed, you had plenty of time to bank some profit. Same here. You took that, not turn trade, the continuation. So you see here, we've got red, green, and if you would have taken that trade to the green, there was still time to get out. And right here, that would have been a key point to exit. So that would have been a nice trade. So here, green followed by red, red, turn, turn. Green, red followed by green. Once again, right there, it broke through. There was time to take some profit. And so here you go, green, red. Once again, it went down, and there was your exit. So once again, you can do the turn trade, and then you see how I'm using the wick zone as a take profit. When it comes back into that wick zone, you can take profit. So that's how you can stack some of these methods. You can use the wick zone as an entry and also as a determiner when to get out of a profitable trade. Just take the money off the table. Buy zone, there we go. Real simple. So you had a pivot here. If you want to fade the pivot, it came right back down, tried to go up, and it didn't. So that should have been a scratch trade. Shouldn't have been too hard to see that. Hasn't hit that pivot. But here, a nice short to the downside. Let's see, we had a candle open in the short zone. It went down, came back and reversed, probably a scratch trade. Right here, this is probably a scratch trade. As you can see, it came back in. It just didn't make it. You had like 1, 2, 3 attempts. Come on, what's it market telling you? So if you had entered short here and you didn't scratch somewhere around here, that's on you. The market was telling you, you weren't listening. As you can see, 32 pip zone, not enough. There's no rat. Once again, pivot was missed. It came down to daily S1, but here you go, another turn trade. Red, green, and there you have it. Off of the H4. Turn with the continuation here. If you waited, you can see profit to be made. Once again, missed pivot. Maybe I should move this chart. Oh well, that's pretty much the same. It's in a good spot. Okay, price action. Here we go again. I sound like a broken record, but 3 ball at the bottom, green at the line, you go long. 1 ball here at the top. There was no red at the line. So you see that? This was green at the line, green at the line, green at the line, no red at the line. So once again, price action's telling you. And you see there wasn't much here. So just learn, just observation. You got some horizontal lines and you got the 3-level ZZ indicator. You see a ball on the next one, you just do what you should do at the line. Once again, H1 candle color at the line. That simple. Once again, here we go. Previous daily session high, open mid, closing low. See, I remember why I didn't put pivot on here. Because we're using this 1 bar ago and we want the current pivot. I could add another indicator, but We've got pivots in other charts. We don't necessarily need it here. Once again, candle color at the line. Red at the line, short. Green at the line, long, scratch. Green at the line, green at the line. This is really so simple. I mean, I've seen some charts lately that were just crazy. They got circles, triangles, horizontal lines, squiggly lines, trend lines. I mean, ellipses. For trading? Really? I mean, it's Independence Day. I want to make you guys independent of all that nonsense because that's pretty much what it is. People will believe what they want to believe. Okay? And here you go, right here. We are in the wick zone. So we either want to short or long, just depending, because price doesn't like staying in the wick zone. And with the holo, we had a lowest open, highest open. You can see here what's happening. So maybe we'll get back to this level, and you'll either have a shorting opportunity. And just so people know, the highest open, lowest open, don't get it confused with the wick zone. It's different. These are the daily wicks of the previous day's candle. This is today's high. This is today's low at the time. This is the highest open, lowest open. Just want to make that distinction because people might see, well, they're the same color. It must be the same. No, it's not. Okay. And price action, you can see here, 53.50. Just not much movement at all. But it's the holiday. Inventory reduction bar, you can see here, we put one in here, put one in here. And right now, there was a small profit to be made here. Not much of one. Right here would have been well, that didn't quite hit it, and that one didn't quite hit it. So don't rush. Don't try to get in 1 pip early. Don't even try to get in 1 point early, because if you do, it could be perilous, to say the least. And just using the high, open, high, low, daily, weekly, monthly, you can see what's happening here. Let's see, I can scrunch this chart. And you can see where previous highs were broken. And you see here, right there, it made it right there. It made a new high, came back into this wick. It's telling you, get out of the trade. Sure, anything can happen, but hey, take the profit. Take the profit. And from Einstein, this is when I turned the computer on. There was a trigger there. Oh, what, maybe a 1 pip profit. It came back down, came back up, failed to make a higher high. What's the market telling me? Here it's making some higher lows. So you could take that chance. It's just like, yeah, it's staying above where I started. So price is going up, right? Frequency distribution. I should probably just take this chart off. I've already discussed it. But if you have any questions, please feel free to ask. It's just real simple. You see here, if you're in the red rat zone, chances are price is going to leave it. Based on the last 100 bars, left it 60 times, 20 or greater or equal to 20. That's the rat. So, fellow traders, I hope you have a happy holiday, fun holiday, and a safe holiday. And when you get back to your trading screen, your trading platform, you start to trade again. Remember one thing. It's not what you trade, it's how you trade it. TheRumpledOne signing off. To go enjoy the holiday.